Hi, and welcome to another edition of Coffee with Brendan. This one was teased a couple weeks ago, and it's entitled, "Is it time to invest in gold?" I'm starting to get more and more questions about gold as a potential investment. Honestly, it's mainly from my more conservative leaning clients. So whatever they're hearing or whatever they believe is starting to make them really second guess and question where the US economy is actually going, and it's causing them to think about gold. And why gold? Gold has always been kind of known to be the safe haven. So whenever there's a geopolitical event that happens or things like that, people tend to start investing more and more in gold, and the price of gold actually goes up. So a lot of people on Wall Street look at that price of gold as almost like the fear index. As the price of gold goes up, it usually means that investors are starting to get nervous about whatever is going on in the world. So what I'm going to do today is do a little bit of a history lesson to see, is gold truly a safe haven? And then secondly, if it's not a safe haven, is it something that should be incorporated into your portfolio? And then if you want to keep listening, I am going to have a little bit of an extra part to this this podcast to talk about, this video to talk about physical gold, that if the US economy truly does melt down, will physical gold be the new US dollar because the US dollar collapses? So we'll get into that in a little bit. So let's start with the price of gold. So let me start sharing my screen and show you, what the price of gold has actually done over the years. And what you see here is that it actually peaked in 1980. And not surprisingly, that was a time when people were very nervous about things. We had Russia invading Afghanistan, we had the Iranian Revolution, we had double-digit inflation, double-digit unemployment. Certainly, there were a lot of things that were really scary about that time at the beginning of the 1980s. But if you look at this, if you invested in gold, the peak in 1980, it wouldn't have been until 2007 that you'd actually start making a profit. In other words, you would have to hold it for 27 years for you to have made a profit. And then from there, 2007, 2008, 2009, all the way through 2011, there was a bull run, and it doesn't surprise many people. That was during the financial crisis, and people were genuinely concerned about whether or not the financial system of the United States would actually survive what we're going through. But then look, again, once people started feeling a little bit more confident in things, those people that bought in 2011 at a high didn't see a return on their investment for 9 more years until COVID in 2020. And since that time, it's gone up to, a peak of, just over 2,000. And now it's come down to 1,800, 1,850, somewhere in that neck of the woods. So long story short, lots and lots of volatility, and that's paid off in the chart that I'm going to show you next, which is here. What this chart on the right is actually showing is how volatile different investment assets actually are. So let's look at this over here. And so if you look at just the US stock market, which is represented by US large cap, the volatility is about 14%. So think about it like this, that there is an average rate of return, and in most markets, you're going to be plus or minus 14% of what that average actually is. So it's a measure of how wide of a range of returns you should actually expect. Now, what most people do when they're putting a portfolio together is they match stocks up with bonds. And why do they do that? Because stocks have a volatility of about 14%, but bonds have a volatility of much lower, about 3%. And so when you think about what's an aggressive investment versus what's a conservative investment, typically people will say, if there's an annual volatility of 14%, that's an aggressive investment. If there's only a volatility of 3%, then that's a very conservative investment. So where does gold lie on this volatility scale. So it's down here, and it's 15% of all the different things on here. It's second only to emerging market equity, which is pretty much third world countries. It's the Russia, Brazil, India, China, those emerging markets that should be first world economies, probably sometime in our lifetime, but right now they're considered emerging. They're very, very volatile, 17%, plus or minus 17%. But that's right around where gold is. It's somewhere between developed stock markets and emerging stock markets. So very volatile. So the idea of gold being a safe haven, it's paid off in that former chart, that chart that I was showing you, that some people didn't make money who purchased gold in 1980 for 27 years. That leads to a lot of volatility in the price of gold. So certainly not, it shouldn't be considered a safe haven, even though its price typically increases during times of volatility and concern and fear. So where is it used, and where should it be used? Well, it's a great diversifier. All these other numbers that are listed here are showing, how these different asset classes, when you're putting a portfolio together, correlate with one another. And you don't want a lot of things that are 100% correlated with one another. So in other words, if you were to match up a US large cap equity index with another US large cap equity index, guess what? The correlation is 1. It's perfectly correlated. When one US large cap goes up, the other US large cap typically goes up. So there's a 1. And then when you look at, let's say, US large cap compared to bonds again, you actually have a negative correlation. In other words, a lot of times when stocks go up, bonds typically go down. That's a negative correlation. So where does gold fit in all this? It is not almost a 0 correlation, which pretty much means it's almost random to the price movements of the US large cap and bonds. So you can almost look at it as a third asset class and a good diversifier to a diversified portfolio. So long story short, use gold for what it's designed to be, which is a diversifier. Don't use it if you're thinking that it's a nice conservative investment that you should invest in when your fear and what you feel is going to happen with the world is going to happen. So those are my base comments that I'd like to do there. If you do believe that the U.S. economy is headed for a meltdown, and that gold should be used for something even more than just a regular investment, but actually as a form of currency, because the US dollar will become worthless if the US economy melts down, listen to the rest of this video. Otherwise, you can end it there and I'll say goodbye and we'll talk to you the next time. But if you are interested in my comments on gold as a currency, let's go into that. So why do people think that? So let's say that the US economy melts down, the US dollar becomes worthless. Will physical gold hold its value? For most, logically, it makes a lot of sense. If you look back over the last several centuries, if you go back to ancient Egypt, King Tut's funeral mask was made out of pure gold. People have looked at gold for literally thousands of years as something valuable. So it makes sense that if the US dollar, which literally is just a piece of paper, but it represents something, doesn't represent anything anymore, it's just a piece of paper, like what happened to the ruble, for instance, in the 1990s, or what happened in Venezuela just recently, or not just recently, but within the last couple of decades. Then gold as a physical currency may be worthwhile. The challenge with that assumption is that if the US economy melts down, I would argue that the world would have a ripple effect, and it would probably crash the entire world economy, except for a couple economies that may survive that kind of apocalyptic situation. And at that time, will we go back to the barter system, which was pretty much the system that was in place before currency? Because remember, currency was kind of a new idea, that instead of saying, I'm going to trade you 5 chickens for that 1 cow, that's how trade used to happen before. They then said, okay, I'm going to use this valuable thing, whether it's gold, whether it's shells, whether it's pretty rocks. They used that thing to signify this is what a cow is valued at. And so will we, in that kind of Armageddon situation, look at gold as a truly valuable thing? Or will the resource of the day rule? So you look at some of the sci-fi, some of the more science fiction type apocalyptic movies. You think of like Mad Max with Mel Gibson. Like oil was the most valuable resource. You could have as much gold as you wanted, but if you had oil, that made you powerful. Or you go to Kevin Costner's Waterworld, fresh water was the thing. So who knows? Who knows in that kind of apocalyptic situation what people will accept as something of value? But let's put that whole argument aside, and let's just assume that that gold is valuable. Okay, so taking that aside, but let's take another what if. What if you're wrong? And let's say you buy a bunch of gold in anticipation of this apocalyptic situation. The apocalypse doesn't actually happen. And let's say that the party that you support actually comes into power and fixes everything. And you're like, okay, you know what? I want to get rid of my gold because that fear that I once had has now passed. How are you going to get rid of your gold? Right now, if you have physical gold and you no longer want it, you have to sell it to a gold dealer. And there's no New York Stock Exchange where, just like, Tesla, if you have a share of Tesla and you want to sell it to someone else, or you want to redeem it and get cash money for it, there's an agreed upon value of Tesla that everyone knows, and you will get for that 1 share of Tesla, and you'll get it pretty quickly. Gold doesn't benefit from that. You actually have to go to a gold dealer and say, I have all this gold, I have this many ounces of gold, give me money for that. Now, you're not going to necessarily get $18 or $1,850 for every ounce of gold that you give to that gold dealer. They will charge a markup, and in some cases, it's a pretty significant markup. So you lose some value of your gold to that dealer, who is the person that's buying the gold from you. So again, from a pure investment standpoint, gold is not the greatest. It has a lot of volatility, as I showed you in the chart over there. And then if you decide that you're no longer enamored with the gold, and that some of the fear that you once had has dissipated, and you try to sell that gold, you're not necessarily going to get the full value of the gold. And I showed you before, the price of gold over time has gone up and down, and it's taken people, years, if not decades, to get your value back once the fear goes up again, because all this stuff kind of ebbs and flows. And right now it's very high, and buying gold at a high right now just makes it even that much more tricky to make money on the gold. So those are all my comments about gold. Again, I don't think please don't take this as I think that it's not a worthwhile investment. I think it is, but use it for what it's good for, and that's diversification of an existing portfolio. I would certainly not, because you're afraid of what's going on with the world, sell a big chunk of your portfolio and buy into gold because you feel like gold is going to be the thing that holds value in, as I said, an apocalyptic situation. So hopefully that was helpful. I'm sure I'm going to get some comments from some of my folks that have expressed some interest in gold about this video, but I welcome those comments and we can talk through it. Thanks a lot and have a great day.